The official cash rate is the tool, but the thing that the Reserve Bank wants to use that on is the mortgage interest rates. And so while some people optimistically think, oh, maybe the banks won't raise their interest rates, inevitably they will have to once the Reserve Bank starts moving the official cash rate, because that's what they want to see happening. Well, hello again, everybody. On February 23, next week, the Reserve Bank will conduct its regular review of monetary policy. Basically, they're going to have a look at where inflation is at the moment, where they see the economy going, the quantities of resources they see available in the economy at the moment and in the future, and of course take a view on where they see inflation going. Now, it's fairly obvious that inflation currently at 5.9% is well beyond the 1 to 3% target, which the Reserve Bank has charged with trying its best to stay within for the inflation rate. And so the expectation for a long time has been that the Reserve Bank will be raising interest rates. And of course, they already have. They've taken the official cash rate from 0.25%, the record low that started back in March 2020, and now sits at 0.75%. And come March 23, at least they'll increase it 0.25. My personal pick is maybe they want to start getting a bit of restraint out there in the economy, and they'll increase the interest rate by 0.5%. Now, what exactly is the official cash rate? The best way to think of it is that that's the interest rate banks must pay if they've got a negative balance in their account with the Reserve Bank overnight. And the higher that interest rate, the greater the effort that banks will make to ensure they don't have a negative balance. And the only way that they can do that is borrowing money from other banks, other operators in the market on a daily basis. So if the banks expect that the official cash rate is going to go up, they will start offering higher interest rates in order to attract extra money from other institutions out there, and that leads to overall interest rates rising in the economy. And the explicit intention when the Reserve Bank changes the official cash rate is that mortgage rates will also change by roughly the same amount, or at least the floating interest rate, maybe the 1-year fixed interest rate as well. So if we get a circumstance where, for instance, the Reserve Bank changes the official cash rate and banks don't change their mortgage rates, well, basically monetary policy hasn't changed. The official cash rate is the tool, but the thing that the Reserve Bank wants to use that on is the mortgage interest rates. And so while some people optimistically think, oh, maybe the banks won't raise their interest rates, inevitably they will have to once the Reserve Bank starts moving the official cash rate, because that's what they want to see happening. Now, there's not only the official cash rate, which the Reserve Bank can use as a weapon to try and lift up interest rates overall, because the official cash rate, it really only affects very short-term borrowing costs for the banks. The fixed rate borrowing that you might be doing, that largely reflects the cost to banks of borrowing money for a fixed term, or at least, at a fixed interest rate. And the cost to a bank of doing that reflects largely market expectations of where the official cash rate will sit in the future, 1 year, 2 years, 3 years, 5 years. And so another tool the Reserve Bank has at its disposal in order to get fixed mortgage rates up is to influence the thinking people like myself have about where they're going to be taking that cash rate in the future. So don't be surprised at all that this year at some stage the Reserve Bank is going to want to get fixed interest rates up a bit higher, and to do that they'll send out some sort of scary message of there's not enough restraint in the economy, they might have to take the official cash rate a lot higher, and that can lead to higher borrowing costs for the banks for those fixed rate loans. So look, we're in a monetary policy tightening phase. I'll probably come back to another explanation about this down the track, but the best way to view it is simply that the Reserve Bank raises its overnight official cash rate explicitly to get mortgage rates up, in order explicitly to slow down our spending, make us spend less, and eventually that will lead to lower inflation. There's just a problem here. There's about an 18-month gap between a change in the official cash rate and a change in inflation. So we're going to be in a rising interest rate environment for quite some time, all of 2022 through into 2023. Good luck out there.